Hi friends, do subscribe our channel ONS Study Circle and don't forget to hit the bell icon so that you can get the latest updates from our channel.
Hello friends, this is Vikas Mani and I welcome you all on this channel ONS Study Circle. Friends, today we are going to talk about activity ratios or turnover ratio. In order to generate profit, which is the most important factor to run any business successfully. In order to generate profit, what is the most activity in turn we can earn a profit for that? That is sales. Because if we do not have sales, regardless of any other key factor, if performs very well, we would not have a profit. For example, if you have a very good labor but you do not generate sales, you will not earn a lot of profit. And the another key factor could be if you can produce a product at a very less cost but your sales are not enough, you will not earn a profit. So sale is the only activity in any business which itself can assure that you will earn a lot of profit if your sales goes up. So while analyzing activity ratio or turnover ratio, we will focus on sales. As far as activity ratio is concerned, it has its various types, and today we are going to discuss on some of its types. Before we start discussing on it, first of all I want you to write this down. Thereafter we will start discussion. As you saw on the board, there are three ratios: fixed assets turnover ratio, working capital turnover ratio, and current assets turnover ratio. Now let us discuss one by one. Fixed assets turnover ratio. The formula is net sales divided by net fixed assets. Why net fixed assets? The reason is simple, because on fixed assets we charge depreciation each and every single year. This is the reason fixed assets value gets reduced every year. So we will pick net fixed assets. Once we pick net fixed assets, the another factor should also be net, that is sales. So the rule would be net sales divided by net fixed assets. What we are going to do using fixed assets turnover ratio, because we want to understand, in order to generate sales, in order to have a particular level of sales, how our fixed assets are performing a key role into that. Now let us discuss on another ratio, that is current assets turnover ratio. The rule is simple: sales divided by current assets. Current assets are those kinds of assets which can easily be converted to cash or maybe cash equivalent within a 1 year. Rule is simple: sales divided by current assets. Sales. Why sales? Because it is the activity ratio, the most important activity in any business, divided by current assets. But why didn't we pick net sales? The reason is because we do not charge depreciation on current assets. Cash itself is a part of current assets and there is no depreciation on cash. So we will pick sales divided by current assets. Now let us discuss on the third ratio, working capital turnover ratio. Working capital formula is current assets minus current liability. Why it is so? As you saw on the board, now let us discuss about the basic conception. In any business, all the total assets would be equal to total liabilities plus the capital invested in a business. And if we just simply use this formula, the capital would be assets minus liability, and working capital is a capital which has a part of short-term current assets and current liability. So the working capital formula would be as same as the formula of capital, current assets minus current liability. So this is the reason of the formula behind this. Now let us understand the working capital turnover ratio. Sales divided by working capital, because we also want to understand how our working capital is performing an effective role in order to generate sales, in order to have a portion of sale, how our working capital is performing a key role into that. And the one more thing we also need to remember, if we do not have sales, we also can use cost of goods sold. Why it is so? Because due to the substitution effect, sales and cost of goods sold, the only difference would be gross profit, and gross profit itself has not much difference, maybe somewhere around 10 to 20% part of net sales. So if we do not have sales, net sales, we also can pick cost of goods sold, but our first preference must go to the sales. But in case of non-availability, we also can have cost of goods sold. For example, if you want to drink coffee but you do not have coffee at this point of time, you can easily have tea, because somewhere the effect would be same. The same logic applies over here. If you do not have sales, you also can pick cost of goods sold, but your first preference would be sales. So friends, this is all about the activity ratios, but there are many more activity ratios we will discuss on later videos. So stay tuned. See you on next video. Till then, goodbye and take care.